Thank you for checking out Real Talk Personal Finance. Shit's about to get real. Cash Flow King with you today, and today with another banger, episode 17, Fixed Annuities. Welcome to the continuation of the mini-series on annuities on Real Talk Personal Finance. We just recorded a show not too long ago, so we don't have a lot of new shout-outs to give. I'm going to try to keep the episodes flowing, so we'll keep the intro fairly short here. But thank you to all our listeners for checking out the show. We appreciate it. If you feel like we've earned it, 5-star review is always appreciated, and you can feel free to share the show with your friends, family members, and so on. Okay, so this is going to pick up basically where the last episode left off. So episode 16 was on annuity basics. Do I need an annuity? And we talked a lot in general about things that would apply typically across the board for almost all types of annuities. Now, we're going to get into the weeds a little bit. And so today, on this lovely Friday afternoon, I can't think of anything else I'd rather do to round out the week than talk about fixed annuities. So that's what we're going to do today. Now, I have broken up my notes here into 4 major sections, each of which has a lot of different pieces that we're going to cover. And we're going to start off here with what I like to call the large cheese pizza, right? This is your basic, nothing fancy, plain vanilla, most elementary type of annuity that you could possibly come across. And that is the acronym that is thrown around is called a SPIA, S-P-I-A. And by the way, if you want to take notes, if you're really interested in this stuff, and if you're listening to the show, you probably are, or know somebody that might be, I would encourage you to do that because there's going to be a lot of information thrown at you today, and you may even want to listen to the episode more than once, and that's cool, but you might want to take some notes as well. So the SPIA, the Single Premium Immediate Annuity. So when we talk about annuities, we're generally going to be talking about either an immediate annuity or a deferred annuity, and we'll go through examples of each throughout today's episode. And then we're also going to be talking about either a single premium or a flexible premium annuity, right? So immediate, as the name implies, basically means income is going to start now. Deferred actually could mean a couple different things, but generally speaking, income would start later. Single premium, lump sum of cash, boom, one and done, that's it. And then flexible premium, ongoing contributions or ongoing premiums paid into a contract. So that's what we're talking about when we talk about immediate versus deferred, and then single versus flexible premiums, just to kind of start it out. So this SPIA, as the name says, is a single premium, so it's a one and done, immediate annuity, meaning that income is generally going to start right away. So SPIA, SPIA. What we're doing in this category or this section here on SPIAs, and then the next section that's coming up, both of those are going to fall under the category of what's called annuitization. And annuitization is essentially when you make a one-time, permanent, and irrevocable decision to exchange a lump sum of money for a stream of payments. In essence, that's what you're doing. You got a pile of cash somewhere, and you're saying, bye-bye. And then you're also simultaneously, sometimes you get it right away, sometimes you wait a little bit. We'll talk about that in the next product type. But at some point, you're going to wave hello to a stream of income payments. That's essentially what we're talking about in the form of annuitization. And annuitization in general used to be a lot more popular than it is today. It is still used today, but as you'll discover as we go through the rest of this show and some of the subsequent shows coming up, there are other solutions now that are used a little bit more often than they used to be. And so some people still choose to use annuitization, but a lot of people are gravitating towards some of these new methods, which we'll get into today and in the future. So back to the SPIA here, single premium immediate annuity. We're making a one-time irrevocable decision to, again, wave bye to a pile of cash and hello to a stream of payments. Those payments will typically begin within 12 months of when we start the contract, right? So those funds go to the insurance company, and then the insurance company will begin making payments within 1 year, depending on how you set up the contract. So you could start one now and say, hey, start paying me next month. Or you could start one now and say, hey, I want payments to start in 4 months. Whatever it is, but it is generally on a SPIA going to be within 12 months, almost always. If you are using, we talked a little bit in the last episode on whether or not you're using retirement funds versus non-retirement funds, that could have different tax implications, and that is true. Again, just a quick reminder, I know I say it on almost every show, but we do this show for entertainment and educational purposes only. There is no advice being given on the show. We do not provide legal, tax, financial, or any other advice. So this is informational only. Please do your own research and due diligence and consult with your own professional before making any financial decision. Just want to get that out of the way. All right, so depending on if we're talking about retirement funds versus non-retirement funds, can have an impact on the tax implications of how this is treated. So I mentioned, I think on the last show, that non-retirement funds or non-qualified funds are subject to what's called an exclusion ratio. And I actually ran some numbers, and we'll give you some examples here in a little bit on what that could look like. But depending on how you fund this, whether you're using retirement dollars or non-retirement dollars, will make a difference on the tax impact when you start receiving those payments. A SPIA is one of the quote-unquote lowest fee type of products out there. So anytime you hear somebody bashing annuities, generally speaking, they're almost never going to be talking about fixed annuities, and certainly almost never going to be talking about SPIAs, single premium immediate annuities. There are other annuity types that we'll talk about in subsequent shows that they are typically going to be referring to. But again, this is just your plain vanilla. There's no ongoing fee. There's no extra fee. Really no nonsense, no frills. It is what it is. And every insurance company is going to price these a little bit differently. So you definitely want to shop around a little bit and get some quotes and make sure you're comparing apples to apples. But what you see is what you get. So the insurance company, your agent, your advisor, if you have one, will give you a quote or give you multiple quotes, and you'll be able to see and know exactly what you're going to be getting. A lot of times those are only good for a very short period of time because they can and often do change. As far as what we like to call the payout rates, they are influenced by a couple different factors, one of which is going to be the interest rate environment. So generally speaking, as rates are higher and in an increasing interest rate environment, the SPIA rates are typically a little bit more attractive. But the larger factor than that is going to be from what we call mortality credits. And generally speaking, the older you are, the more advantageous and higher the payout is going to be. And so back in the day, when interest rates were a lot higher than they are now, you would oftentimes have people, especially older retired people, that might go to the bank and put some money in a CD and then decide that they wanted to live off the interest. And back when rates were significantly higher than they are today, that might have been a viable option for them. But if you think about it, we'll take an example here. Hypothetically, let's say you had 3 different individuals all go to the bank or credit union today to purchase a CD, a certificate of deposit, and one person was 35 and they have, let's say, $100,000. The next person is age 55, they also have $100,000, and then the third person is age 75 and they have the same $100,000, and all 3 of them walk into the bank or credit union and say, I would like to buy a CD, a certificate of deposit, for $100,000. Guess what interest rate they get? All of them. It's the same. There is no difference. The 35-year-old is going to get the same rate as the 55-year-old, who's going to get the same rate as the 75-year-old. Now, what do we know about these hypothetical individuals strictly based on their age? Well, for one, really nothing, right? But realistically, number 2, we know their ages. That's all. And that's all we need to know. And if we look at it from the insurance company standpoint, that's generally, there's a little bit more to it than that. But one of the major factors, almost all that they need to know, and the reason why is that generally speaking, the 35-year-old is probably going to live a lot longer than the 55-year-old, and the 55-year-old is probably going to live a lot longer than the 75-year-old, and the 75-year-old is probably going to kick the bucket first, right? We know that. They know that. And so because of that, when we look at what's called mortality credits, the older person, if those same 3 people took $100,000 and bought a SPIA, a single premium immediate annuity, and they waved bye to the $100,000 and hello to a stream of payments, the 75-year-old is going to get the best deal because they're the one that's closest to their deathbed, just actuarially speaking. That doesn't mean that the 35 or 55-year-old can't get hit by a bus the next day and die before the 75-year-old. It does happen. But when we're doing this at scale, and we're looking at it from the standpoint of the law of large numbers from an insurance company standpoint, they don't know exactly who's going to die or not, or who's going to live to 100 or not. But they do this enough with enough people and enough information that their actuaries are smart enough to figure out, on average, how long most people are going to live, right? And women generally live longer than men. But when we look at ages here, like that's another thing that they'll look at as far as the annuity payouts go on a SPIA, if it's a male or female. But the age is going to be the other big factor that comes into play there. And so if the plan was take $100,000, put it in the bank and live off the interest, and we had 3 people with very, very different ages, and those 3 people went to the insurance company and each bought a SPIA, the 75-year-old is going to get a much better deal. They're going to get a much higher payout rate. Their income stream that they're going to receive is going to be a lot larger because the insurance company is expecting that they're not going to have to pay it out for as long. And obviously on the flip side, the 35-year-old is going to get a much smaller payment because ostensibly the insurance company is going to have to pay out that income stream for a lot longer period of time. So that kind of makes sense. But there's a lot of reasons why, and you can make use cases in different situations. If you have a professional athlete or somebody has a big, malpractice suit or settlement or something crazy happens, there are younger people that might use these types of products. But generally speaking, you don't see it all that much. You typically see people that are a little bit older using them. And as we go through, we won't go through in excruciating detail, but there's a tendency for there sort of to be a sweet spot with a lot of different types of products. And one of the magic numbers in terms of age, and it's going to vary based on product type, product line, insurance company, and so forth, but 65 is very common. That's kind of the sweet spot where most people are either retired or getting ready to retire. They are a little bit older, but they have quite a bit of life left. They've also typically accumulated a significant amount of assets. They're also potentially worried about any market downturns that they might experience in their stock market-based investments. And guaranteed income sounds a lot more attractive and palatable to a 65-year-old versus somebody that's 22 that's just working their first job and doesn't give a shit about retirement, right? And probably doesn't have any money and probably is going to live a long, long, long time. So these types of contracts in general, you're going to see older people have a tendency to gravitate towards them. And again, as I mentioned on the last show, we're talking about product types and we're getting into some of the nitty-gritty of that. But keep in mind that anything and everything that you or anybody else does as it relates to these needs to be done in the context of your overall financial plan and situation. And I feel, and I probably sound like a broken record when I say that, but it is very, very important to keep that in mind. So we're going to go through this to get you the information, but just you have to do this in the context of your situation. So I have some numbers here that I was able to run on a SPIA just to kind of take a look. And you can set it up different ways, right? You can do what's called a single life only. Some people or some companies will just call it life only, where, hey, I, Mr. Cashflow King, let's say I'm 65 and I got, $500,000 that I want to put into a SPIA, and I decide to go ahead and do that. And if I get hit by a bus tomorrow, I don't give a shit. Nobody gets anything. If that was my thinking, then I might choose the single life only or life only option, where it will pay out to me as long as I live, whether that's to be, 87 or 187, doesn't matter, right? But if something unfortunate and unforeseen happens and I die prematurely, that money's gone. Insurance company keeps it. Not a lot of people will set it up with life only or single life only. It is an option. Technically, it's the way to get the highest payout. But a lot of times, if you add a little bit more certainty, whether you had like a survivor, let's say, or a joint in survivor type of deal where you have somebody else listed, or even if you did a period certain, that's also fairly common. So you might have, for example, say, all right, I'm going to do it for my life, but I want a 10 or a 15 or a 20-year period certain. And so that means it will pay out for the rest of my life, no matter how long that is or not. But if I get hit by a bus tomorrow and I chose a 20-year period certain, for example, it's going to pay out for at least the next 20 years to my named beneficiary on the contract. And those types of elections are far more common than a single life only or life only election. And generally the payout will always be less, but generally it's not going to be that much less, right? So I took a look, I ran it as a single life only and then a single life with 10-year period certain and kind of blended the two. So these numbers are kind of rounded, they're not exact, but we took a look at our SPIA contract that we have. We assumed that we had a male age 65 who had $500,000 that they wanted to put into a SPIA contract. And I ran it a couple different ways. But if they had no COLA, no cost of living adjustment or no inflation adjustment on their payments, if that payment that they get today is going to be the same as the payment they get 27 years from now, assuming they're alive 27 years from now, for example, will be the same, right? So the numbers, the way that that came out was if they put in $500,000 and they were a male at age 65, they would get a payment of about $2,700 a month, which comes out to about a 6.5% payout rate. So we look at, okay, what is the monthly payment? We multiply by 12 months. That gives us our annual payment. And then we divide that by the amount that we put into the contract, in this case, $500,000. So we take the $2,700, multiply by 12, divide by $500,000, and we can see that our payout rate is about 6.5%. It's not going to be exactly that. Again, I rounded some of these numbers because I took the difference between single life only and single life with 10-year period certain. But just to kind of get in the ballpark, it's going to be in that neighborhood, right? Now, if you did a 3% cost of living adjustment or 3% COLA on a SPIA, and again, different companies are going to run these differently, so you'll see rates all over the place. From the time that I'm recording this until the time that you listen to this and the time that you may be interested in this, that's 3 different time frames, and rates are going to change, and payout rates and everything else is going to change pretty much every single day. But right now, at a 3% cost of living adjustment on that same $500,000 for a male that was age 65, you're looking at about $2,100 a month. So it's about $600 a month less, which is about a 5% payout rate, right? So we know the payments are going to start much lower, but we also know they're going to go up by 3% per year. And different companies will do it differently. Some of them will let you do between 1% and 5%. Some will let you do 3%. Some will let you do simple interest. Some will let you do compound interest. Some will let you choose either or. Some won't have it at all, right? And you'll see similar things even with defined benefit pension plans that we kind of mentioned briefly on the last episode, where somebody goes to work for an organization, they have a defined benefit pension plan, and they choose their payout option. A lot of those payout options, there is no inflation adjustment. And so, especially in the context of today where inflation has just been out of control, you have to take those things into account. Even inflation over the past about 100 years or so has averaged around 3%. So if you're not thinking about inflation, you definitely should be. And again, this is why it's so important to do this in the context of your overall plan, because if you have other assets that are designed to outpace inflation, you may decide that you want to purchase a SPIA with a portion of your portfolio where the payment doesn't necessarily go up, but maybe you're buying a little bit more income than you might need right at this moment, knowing that inflation is going to run its course, but also knowing that you have other assets that are going to exceed and outpace inflation that can later be used in exchange for income, and you can always purchase additional contracts if needed, and you wanted to make it up on the back end. So there's different ways to think about it. But some people say, screw that, like I'm just going to go ahead and put the COLA on there, and I don't care that the payment's a lot lower now, I'm fine with that. So you have to figure out how it fits in to your specific situation. Last thing I'll say about the SPIA and just in running these, if you did this with retirement money, there's really no change, as I mentioned on the last episode, in terms of the taxation. So if you had a pre-tax retirement plan before and you had it invested in whatever and you took a withdrawal from it, similarly, if you use that same money to purchase a SPIA, let's say, and it was, retirement funds that funded it, and as you're getting those income payments, it's going to be treated the same way, right? Pre-tax money is going to be taxed at ordinary income as it comes out, just as your payments would be taxed as ordinary income as you receive them. However, if you used non-retirement money to purchase a SPIA in this example, then you would be somewhere in the neighborhood, depending on if you did it with or without the cost of living adjustment, somewhere in the neighborhood of about a 75 to 77% exclusion ratio. And that basically means that of every payment that you receive, about 75 to 77% in these particular examples would be excluded from taxation, right? It would be considered a return of principal, and the rest of it would be considered taxable. So again, you always want to consult with your tax advisor on these things, but that's something that's worth noting. All right, so I think that's section 1 of 4 for today. Single premium immediate annuities, or SPIAs. That's what I had to say about that. The next one that falls under that same category of annuitization is going to be called a DIA, right? SPIA DIA. DIA, a deferred income annuity. Oftentimes, actually almost always, these are also going to be single premiums. So you have a deferred income annuity, single premium deferred income annuity. So again, we have a pile of money, we're putting it in all at once, boom, single premium. We're not going to receive income right away. We're going to defer it, hence the word deferred. And it is an income annuity where it's going to pay out income to us over time, presumably for a lifetime. And again, as I mentioned, there's different ways that you can set that up. Because this is a form of annuitization, it is also a one-time, permanent, and irrevocable decision. Payments are generally expected to begin several years in the future. So you could say, if you're getting a little bit closer and you say, all right, I'm probably not going to need income for another 5 years. I know I want to annuitize. I've run my numbers based on my situation. I want to do a DIA that kicks on in 5 years. You could go ahead and place funds into a deferred income annuity contract, and you could start those payments in this example in 5 years if you wanted to. Some companies, before the lifetime payments actually begin, will let you make a one-time change to that. So you could initially say, all right, I think I'm going to need income in 5 years. I'm going to set it for 5 years from now. And let's say 3 years from now, you get a little bit closer and you're like, I actually don't think I'm going to need it just yet. I could kick it out another couple of years. Not all, but some companies out there will let you make a change before the payments actually begin. So you want to check with the company that you're working with. You want to check on the specifics of the contract that you're getting into if you decide to get into one. And you really want to have an understanding of what that looks like and are you allowed to change it and how often. And a lot of times there'll be a limit on like how many years. So there's some of them will say, all right, well, you can make a one-time change, but you can't change it more than plus or minus 5 years than what you initially said. So let's take a slightly different example. Let's say you decided, all right, I want to purchase a DIA, a deferred income annuity, and I'm going to start income in 10 years. Let's say you did that at contract issue when you started it. And you get 2 or 3 years in and you say, well, I want to make a change. One company might tell you, all right, you can make a one-time change, but it has to be plus or minus the 10-year delay that you initially said that you wanted. So you could kick it out to a total of 15 years, add 5 years on one way, or you could bring it back to a total of 5 years and go back 5 years in the other direction. So I said 10 initially, but now I can go plus or minus 5, and I can do that one time. That would be an example of a company allowing you to make a one-time change within certain parameters. So again, it's going to vary and be different. I'm just giving you a hypothetical example, but you want to check with the company that you're talking to. All right, so payments begin generally several years into the future. We talked about that. We talked about the exclusion ratio. The exclusion ratio here is also going to apply for non-retirement money. And so anytime you hear the words exclusion ratio, you should always think non-retirement money, right? This does not apply to retirement funds. But if you're purchasing one of these with non-retirement funds, then you do get to benefit from the somewhat favorable exclusion ratio. And you'll see when we get a little bit further in today's show how that's a little bit different from other types of contracts that may not benefit from the exclusion ratio. So we'll talk a little bit more about that later. This DIA, the deferred income annuity, is also another one of the lowest fee type of products. So it's very similar to a SPIA. The only difference is, there's probably a couple differences, but the main one is the timing of the payments. SPIA says, here's some cash, insurance company, pay me now or within a year. And the DIA says, hey, here's some cash, insurance company, pay me later. And they just want you to tell them when you start the contract. And some of them will let you change your mind before you start the payments, other ones won't. That's basically what we're talking about, what we're looking at here. These contracts also benefit from mortality credits. So as you might expect, the longer that you wait, the higher the income stream that you're going to be able to generate from some of these contracts. And as I mentioned earlier, the interest rate environment can also have an impact on the payout rates on some of these contracts. But the biggest factor is going to be your age, but also the delay period in terms of when you turn on the income. I would almost never suggest this, but there are some contracts out there that will let you start them and then delay for decades. I would make an argument that you could probably do far better by investing your money elsewhere and growing the capital over that time period, and then wait till you get a little bit closer before you consider putting it into some type of an annuity contract. Everyone's thoughts on that are going to be different. Again, that's largely going to be a function of your risk tolerance and fitting all of that into your own plan, but that is something just to kind of keep in mind. So took a look at the DIA for comparison purposes here. Same situation, $500,000, 65-year-old male, and we decide we're going to do a 5-year delay, right? So if we're 65 when we put the money in, we're not actually going to take the income until we're 70 in this hypothetical example. If we did that, we would be looking at, with no cost of living adjustment, about $3,500 a month, which is about an 8.5% payout rate. Remember back to the SPIA, where same situation, but if we took income right away, we would only get $2,700 a month, and it was only about a 6.5% payout rate. So by waiting 5 years in this particular example, that's going to give us an extra $800 a month, and $800 a month, and then it would improve your payout rate by about 200 basis points, or 2%, 2 full percentage points. So from 6.5% payout rate to 8.5% payout rate on the DIA. With a 3% COLA on the DIA, on the deferred income annuity, we'd be looking at about $2,800 a month. Again, 5-year delay. And the payout rate on that's about 6.75%, 6.75%. And the exclusion ratios on these are slightly lower at 72 and 74%. So again, if and only if you funded these with non-retirement funds and only non-retirement funds would that matter. But if you put that $500,000 in, let's just say you had cash chilling in the bank and you wrote a check and you put it into a DIA and you started getting payments 5 years from now, and let's say you didn't have the cost of living adjustment on there. So I'm 65, I got $500,000, I want to put into a DIA, I write the check, I start income at 70, I'm getting $3,500 a month to my face. How much of that is taxable? Well, we have a 72% exclusion ratio in this case. So 72% of that payment is going to be excluded from taxation, and about 28%, the remainder, is going to be subject to taxation at ordinary income tax rates. So that's how that would work. Again, for retirement money, where a lot of these are purchased, it ain't going to matter. You're going to pay the taxes as the money comes out. If it was pre-tax money beforehand, you're going to get taxed at ordinary income tax rates when it comes out. If it's Roth money and you're taking a qualified distribution, as we talked about several times over the course of these episodes on the show, if it's a qualified distribution, then it's going to be tax-free no matter what, right? So there's different ways to set these up. You could actually do this with Roth money and get a tax-free lifetime income stream if you wanted to. So again, the takeaway there is the exclusion ratio only matters if you're talking about non-retirement dollars funding these contracts. If you're talking about retirement dollars, then you just follow the rules of that particular plan and that particular distribution from that plan. So pre-tax money is going to get taxed. Roth money, if you play by the rules, is not, right? So that's something to keep in mind. One special type of DIA, deferred income annuity, that exists that you may hear about. It's actually, it got a lot of, press when it first came out. I think it was maybe back in 2014, something like that. But not a ton of people are using them. There are some that are. There's kind of some very limited use cases, but you may hear about it, so we'll mention it here on the show. It's called a QLAC, a Qualified Longevity Annuity Contract. QLAC, Qualified Longevity Annuity Contract, a QLAC. This type of DIA, this type of deferred income annuity, is available for pre-tax retirement funds only. That's a very important distinction from everything we've talked about so far. This is only available with pre-tax retirement funds. It is not available for Roth. It is not available for inherited accounts. It is not available for non-retirement money. It is only available for pre-tax retirement money. And one of the main benefits of using a QLAC, if you decide to, is you can actually avoid required minimum distributions, or RMDs, which I don't know if we've talked about that a lot on the show or not. I think I mentioned it a little bit and talked about it a little bit on the Roth episodes. We may do a show on RMDs or something in the future. I always come up with different ideas in the middle of episodes, which is kind of nice, but always welcome to feedback. So realtalkpersonalfinance@gmail.com if you have any show ideas. Again, that's realtalkpersonalfinance@gmail.com if you'd like to email the show. Let's see. So you would avoid required minimum distributions, or RMDs, on a portion of your assets, and that would be the portion that's in that QLAC. So you can typically, if you look at it in the aggregate, you can put in about 25 or up to 25% of your assets that's capped at about $145,000. And if you decided to do that, again, RMDs for most people now generally will start at age 72. There's talk of them changing that. For some people that have been taking them for quite some time, you may be subject to the older rules at 70 and a half. But for most people, if you're not already 72, your RMDs will begin at age 72 from most of your pre-tax retirement accounts. There's always a couple of exceptions to that. But you can put in up to 25% capped at $145K. And what that does is allows you to defer RMDs all the way out, if you wanted to, until age 85. So depending on your retirement income plan and your need for the funds and how well funded for retirement you are and whether or not you think you may or may not run out of money. A lot of people will basically tuck away and have the special classification on this type of a DIA where they have essentially a spigot of money that turns on at 85 if they should live so long. And so one of the main worries of a lot of people is running out of money in retirement. Well, wouldn't it be nice to earmark some funds now for that purpose later, to put them aside and not have to be subject to RMDs now? But if you live, quote unquote, too long, which I know that sounds probably ridiculous, but if you are one of the individuals that is going to live to be 100 plus, well, when you get to 85, all of a sudden now you have this income stream, additional income stream, hopefully, that kicks on for you at that time. In the meantime, you've had basically 13 years of avoiding having to take out minimum distributions based on the value of those assets. And there's some very specific rules about that. I'm not going to spend too much time on this here. If you do have questions, you can always email the show, realtalkpersonalfinance@gmail.com. But there are specific types of annuity contracts, specifically fixed annuities, where you have to use one of those to have it funded. So it can't have a cash value. It can't be in a variable product. There's a lot of different rules about QLACs, and it's not going to be right for everybody. But for some people, it may be something that they might want to consider. So that rounds out section 2 of the show. Remember, I had 4 different major categories I wanted to talk about. So far, we've covered 2 of them. So we're just going to keep it moving here. The third one is going to be somewhat similar to what we just talked about, yet very different than what we just talked about. So one of the things a lot of times I'll break down for clients when they ask about income or guaranteed income, and when we're going through the retirement income planning process, we basically look at, all right, if we're talking about generating guaranteed income, first of all, there's different ways to do that. But if we're talking about it in the context of annuities, there's the category of annuitization, which would encompass pretty much what we've already talked about, right? A SPIA, a single premium immediate annuity, or a DIA, a deferred income annuity. Generally, it's going to fall under the annuitization umbrella, where we make that permanent, one-time, irrevocable decision to exchange a lump sum of money for a series of income payments, right? But also, on the other side, we could basically do the same thing, still have access to our money or a portion of our money, and we could choose to pay a little bit of an extra fee for the flexibility and control that provides. So there are certain contracts out there. We'll talk a little more on some of the upcoming episodes about the other types of contracts and how some of these riders work on those. But in the context of today's episode for fixed annuities, there are some income riders that are available on some, not all, but on some fixed annuities out there that allow us to basically simulate the benefits of annuitization, namely lifetime income payments. And we can do that and still retain the right to change our mind at certain points in the future if we want to access our money or a portion of our money at certain points in time if we decide that we want to. We've not made that permanent, irrevocable decision to wave bye to it, right? Once you annuitize, that money's gone. You're never going to see it again. You need a new roof. You need a new car. Shit hits the fan. Too bad. Hopefully you got other assets. Hopefully you did a comprehensive plan. Hopefully you didn't put all your money into an annuity and you didn't have some shitty advisor telling you to do that, right? So with these income riders, essentially, we can simulate that and have a lot of the same benefits, but still have access to a portion of our money if we needed it. Now, I will tell you that generally speaking, there's always going to be an exception, but generally speaking, annuitization, because it's the least flexible and there's the most amount of restrictions, namely you wave bye to your money, the payouts on those to you as the client are going to be the highest, right? However, for these other types of contracts out there, there are some cases where you can get just as high of or almost just as high of a payment, but still maintain some control. And so as I alluded to and mentioned at the top of the show, there are some newer types of riders and contracts and all this stuff that's out there now where fewer and fewer people seem to be annuitizing because they like the idea of lifetime income, but they don't like the idea of making a permanent, irrevocable decision to wave bye to their money. So how do you marry the two together? And that's where a lot of these products were born. So we're going to talk in general now just about some income riders that might be available instead of annuitization on certain types of fixed annuities. So there's different income features, and there's different riders that can be on contracts. And we had GMIBs and GMABs and income benefits, accumulation benefits. We had all kinds of shit. But the number one most common today that we see is what's called a GMWB, which is a guaranteed minimum withdrawal benefit, GMWB. And every company is going to call it something different. It could be a guaranteed living benefit, guaranteed lifetime withdrawal benefit, guaranteed minimum withdrawal benefit. There's all types of acronyms. But basically, we're saying here is the least amount that you're going to receive as a guarantee from this annuity contract under the terms of this rider for a particular fee. That's basically what we're talking about. So fixed annuities can, in some cases, have these guaranteed income riders that can be added to the contract. Typically, that happens at contract issue. So when you start the account, you have to make that election. Some contracts are available with or without an income rider. Some of them only come with an income rider. Some of them you may have a choice of more than one income rider. So you want to, take a look around and make sure you understand what it is that you're looking at. But these riders can be available on fixed annuities. And as I mentioned, it essentially allows for the same benefits of annuitization, right, of a SPIA or DIA without subjecting the funds to that permanent irrevocable decision. A lot of contracts out there will allow an income rider on a fixed annuity, or really any annuity, to be canceled at certain periods in time. And usually that happens after the surrender charge period. If you remember back to the last episode, in episode 16 on Annuity Basics, we talked a little bit about surrender charge periods. And just as a refresher, when we're talking about these deferred annuities that aren't necessarily used for income, but they're not what you would think of as your typical income annuity. So if we're talking about, an income rider on a fixed annuity that is either a single or flexible premium annuity, but it's a deferred annuity. It's not a SPIA and it's not a DIA. It's just a contract that allows you to add a benefit onto it, a living benefit, which would be, in this case, an income benefit onto it. They will have a surrender charge period. This is typically going to be a period of time where you're subject to some limitations on accessing your funds, right? Could be, as I mentioned earlier, could be 3 years, 5 years, 7 years, 10 years, 15 years, 20 years. I mean, there's a whole host of different contracts out there. 7 years, sometimes 8 years seems to be fairly common with a lot of these contracts. So if you have an income rider, and let's say you had a 7-year surrender charge product or contract, you may not be able to cancel it in some cases until after that 7-year surrender charge window is gone, right after you've been in the contract for 7 years. Other times, you might have a 7-year surrender charge contract, but you might be able to cancel the income rider if you wanted to after, say, year 5, for example. So every company and every contract is going to be different, and you want to make sure you understand the rules of that. And I don't want to focus too much about canceling, because hopefully you're not doing this if you're thinking about canceling it, right? But sometimes situations and circumstances change. You might need, based on your plan, a retirement income stream, or want an additional retirement income stream. And then all of a sudden you walk outside one day and $10 million falls out of the sky and you say, well, shit, I don't need this anymore. Well, you can cancel it. If you annuitized under the previous 2 sections, you would have that income coming in no matter what, which isn't necessarily a bad thing. But if your life circumstances and situation changes later, you don't really have a lot of flexibility to make changes to that contract because it's kind of a done deal, right? So that's something else that's kind of neat on these. It gives you the ability and the option to, quote unquote, change your mind later if circumstances dictate that that's something that you need to do. On a fixed annuity with a rider like this, you are going to earn interest on the account value. So you're going to put however much money into a contract like that. They're going to have a certain interest rate that they'll declare. Usually it also will have what's called a minimum interest rate, a guaranteed minimum interest rate, GMIR is what we call it in the industry. And that is the minimum amount of interest that will be credited to the account value. But you're also going to have a declared rate, which is oftentimes higher than the minimum. They say, hey, we'll pay you this, but no matter what, if shit hits the fan, it's not going to be less than the minimum, right? That's kind of what we're talking about. And there will also be a rider fee. That company is going to charge you a fee to provide lifetime income to you under the parameters of this income rider. Well, you're going to have to pay a rider fee, which is typically deducted from the account. The account is also going to be accumulating and earning interest. And so a lot of times, especially in today's low interest rate environment, the small or low interest rate is going to partially, in some cases completely, offset the fee for the rider, depending on how much that is, and it's going to depend on the company. Right? I've seen them all over the place. especially on some of the other contract types, are typically a little bit more expensive. But generally speaking, plus or minus about 1% is realistically what you're going to be thinking or talking about with this type and one other type of annuity contract out there. And then on a lot of cases, on some of the other ones, you get well north of that. That in some cases, you might have contracts, if you've had one for a while or you find an older one out there, there were times when it was just north of 0.5%. So it just depends, and that's just for the rider itself. So there is an additional fee, but you're also going to be earning interest on the account value, which can help to offset that fee. It's important to know that on a contract like this, whether you use retirement money or non-retirement money, you have not annuitized. You're getting the benefits of annuitization, right? The company's going to say, all right, well, we're going to pay you based on your age. And when you start lifetime withdrawals, here's the percentage that we're going to pay you based on a number of different, well, not a number of different factors, but every company calls it something a little bit different. You're going to have your account value. That's the cash you start with. And then you're going to have another figure. And it could be, some companies will call it a withdrawal value or withdrawal-based value. Some companies call it a benefit base. Some companies call it an income base. Some companies call it an income benefit base. It's basically a fucking number in the clouds. And say, hey, if you put, $500,000 in this contract on day one, then your number in the clouds on day one is also $500,000. But after that, we're going to do some fucking tricks magic on you. And that number will change over time. Generally, it's only going to go up. But at the same time, your account value, the cash in the account, can generally only go down other than the interest that it's accruing. But as you make withdrawals, that number will go down. And what happens is eventually you withdraw that account value, that cash in the account down. And if you live long enough, eventually it goes to zero. But that number in the clouds that you started with, and that's the number upon which your lifetime income is based on, that is not going to go down. And you're going to continue to get those payments in perpetuity as long as you live, in most cases, right? Sometimes you can do a rider that allows you to include a spouse if you're married. And a lot of times the payout rates are a little bit less because the insurance company has to cover 2 different lifetimes in that case. So it gets a little bit tricky and complicated. But the point is, no matter how you fund a contract like this, a fixed annuity with a lifetime income rider on it, there is no exclusion ratio. So remember when we talked about annuitization before, if you used retirement money, doesn't make a difference. If you used non-retirement money, you had the exclusion ratio, which was somewhat favorable. Well, now on this type of a contract that is non-annuitized, it's going to be considered, as I alluded to and mentioned in episode 16, it's going to be considered LIFO, which stands for last in, first out. The last money in the contract that comes in, which is typically going to be the interest that gets credited to it, is going to be the first money that's deemed to have come out when you start taking withdrawals out of it. So it's usually not quite as favorable. Last in, first out is usually not quite as favorable as the exclusion ratio. However, especially on a fixed annuity, where we're talking about fairly low interest rates and fairly low interest accrual and the account value really not changing that much. If anything, it's going to be going down. It's really, for fixed annuities, not a major consideration, but it's important to know. So you're not going to have, you're not going to hit a fucking grand slam out of the park on a fixed annuity because you're not really investing the money, right? I mean, it's just a fixed interest rate that you're going to be getting in this case if you're not annuitizing. And it's generally not going to be all that much. So there's really not going to be all that much gain in the contract. So when you say, okay, well, it's last in, first out, well, who gives a shit, right? Because it's not that much to worry about. So that, in the reality is that's the case. So let's see. Exclusion ratio is not a thing here on this type of a contract. Some contracts allow for changes to happen if you have certain like life events that happen. So let's say you're single and you have a contract like this on yourself, and then all of a sudden you get married, and you're like, well, shit, I want to add my husband, or I want to add my wife, or I want to add whoever on this contract so that they also can benefit from the lifetime income, right? A lot of people want to do that. Well, some contracts say, tough shit, it's based on how it was issued, and it was issued back when you were single, and it doesn't matter. And other ones will say, all right, cool, you got married, you had a life event, great, we'll let you now add your spouse on, and you can make a change to that in some cases. Similarly, if you were married and you did do a joint type of rider where you were covering 2 lives, and all of a sudden, let's say somebody passes away, right? Spouse passes away, or even worse, you get divorced, and you have a life change like that, you can remove that ex-spouse from the contract in some cases, right? So you got to, again, read your contract, talk to your advisor, the insurance company, your agent, whomever, and make sure you fully understand what's going on. But those are some cool features that some of these contracts have. And then the last thing I'll say about Section 3 here is you can usually, almost always, still annuitize later. So let's say, and this isn't the last thing, I actually have an example that I'm going to go through in a minute, but let's say that you say, all right, I like how this lifetime income thing sounds. Annuitization is dog shit. I don't want to wave bye to my money right now, at least not yet. So I'm going to do a particular contract for today's purposes because we're talking about fixed annuities. Let's say somebody does a fixed annuity contract and they add a lifetime income benefit onto that contract. So now it's basically functioning in the same way. They're getting a lifetime income stream based on the factors and parameters of that contract. And then all of a sudden they say, all right, well, you know what? Maybe I should have just annuitized in the first place. Fuck it, let's annuitize, right? Let's just say that's what this person is thinking. Well, in some cases, almost all cases, you can, but you have to check with the company in terms of when. So there's some companies out there that won't let you do that for the first 3 years of the contract. Some companies might not let you do that for the first 4 or 5 years of the contract. Just depends on your specific contract, but you can generally almost always still annuitize later, assuming that there's contract value remaining, right? So this is another thing that comes into play. Yes, there's oftentimes going to be a waiting period if you go into a different product like this and later choose to sort of change your mind and you decide you want to annuitize to try to get a little bit more payout, a little bit more income stream. You can. There's usually a waiting period that you have to go through before you can. However, you want to make sure that you're not waiting too long to do that because it's going to be based on the account value, the cash in the account. You remember that number in the clouds thing, that income based, that benefit based, that income benefit, that thing that has 30 fucking names and nobody can keep them straight, that's essentially initially equivalent to your deposit in the contract or your premium in the contract. Well, they're not going to base it on that. They're going to base it on how much cash is in there. So if you've been in a contract like this and you've been taking distributions for many, many years, you've been paying the rider fee for many, many years, your number in the cloud stays the same, but your actual cash in the account value or contract value goes down and down and down and down and down, you probably don't want to annuitize it at that time because it's not going to be to your benefit. They're going to use the cash in the account to determine how much your annuity payments are going to be if you annuitize that amount. So you're better off just sticking with the plan and staying in that contract and getting those lifetime income benefits that are attached to that contract. I know that's probably a lot. If I lost you, sorry. Again, email the show, rewind it, and I can always do a little Q&A and come on after the annuity series and have some people write in with questions. I can answer some questions and try to clarify a couple of things. But the point is, so far, what we've talked about up until this point in the first 3 out of 4 sections of the show is we want to do everything in the context of our overall financial plan. We've said that a million times. Got it. The first 2 sections on single premium immediate annuities or SPIAs and deferred income annuities or DIAs, both of those fall under the umbrella of annuitization. Bye to my money, hello to income streams, irrevocable, can't change my mind, can't access my cash later, tough shit, right? That's what we said so far. And then in section 3, what we've been talking about now just most recently is, all right, I like the benefits of 1 and 2, but I don't want to wave bye to my money forever. I want the ability to change my mind. That's where option 3 comes in. And in this case, it's a fixed annuity, earns a fixed rate of interest, right? Has an income rider on there that says, hey, we're going to kind of set this up and function similar to annuitization. We're going to give you some payments. Here are the guarantees. Here's how much we're going to pay you. And that's what we've been talking about so far. And all I've said here at the end is some of those contracts will let you change your mind and go back to numbers 1 and 2 and annuitize later. My point is, you just don't want to wait too long to do that, or it's not going to be to your benefit to do so. That's where I was going with that. So hopefully that clears that up a little bit. All right, really the last thing on this section is I want to talk about just a quick example of a fixed annuity with a rider. So to stick with the same example, 65-year-old male, somebody decides they have $500,000, $500,000 that they want to put into a contract like this. If they did that and they started payments right away, and they did that with a fixed annuity that was a deferred fixed annuity, right? They would receive about a 6% payout rate on this particular contract. There's other ones out there. And that would equate to about $2,500 a month, all right? And if we go back to our annuitization quotes, remember we were anywhere from $2,700 a month with no cost of living adjustment. If we added that in, it would be a little bit lower. And we talked about the numbers on the DIA, which really isn't apples to apples because the DIA has a 5-year delay. But if we just look at the SPIA from number 1 there, the single premium immediate annuity, buy to $500,000, hello to income payments, pay me now, let's go, we get $2,700 or about a 6.5% payout rate. If instead we say, all right, well, we're not quite ready to part with it forever. We kind of want to do that, but we want the ability to change our mind, and we're okay with operating within the parameters of another contract that gives us the ability to essentially change our mind. All right, great. We can get $2,500 a month instead. So most clients will be like, well, it's $200 a month. Who gives a shit? I want the ability to change my mind. And so a lot of people are going with these newer type of deferred annuity products that have lifetime income riders, right? So that's what we just talked about in number 3. And that's just a quick example of what that looks like. All right, the last thing I want to cover on today's show under fixed annuities, so section 4, category 4 of 4, are going to be basically just a deferred fixed annuity that does not have a lifetime income rider. This could be a single premium deferred fixed annuity. It could also be a flexible premium deferred fixed annuity. So quick distinction on that, and you may already know this by now, but we're going to go over it anyway. Single premium fixed annuity, boom, here's a pile of cash, pay me some interest. Let's go, right? It's not an income stream. It's just, I want to grow this cash, kind of like a CD, give me some interest, right? A flexible premium would be similar, except I want to continue to make payments, deposits, contributions, whatever you want to call it, into this contract. I'm going to put some money in now, and I'm going to put some money in next month and the month after that. I'm going to set this up systematically or just whenever the hell I feel like it, so I can put subsequent deposits or premiums into this contract. That would be a flexible premium fixed annuity, okay? So in either case, it is possible to use, and I mentioned this on the last episode, a fixed annuity to benefit from earning interest at a particular interest rate. So most of the time, fixed annuities are going to earn interest rates that are usually quite a bit higher than the local bank or credit union is going to be, right? Which is kind of nice. Also, that will come with, as I mentioned, I think I mentioned this in the last show, but in case I didn't, the interest that's earned, or any earnings, in this case, we're just talking about interest because we're talking about fixed annuities, is tax deferred, right? And you may never have an intention of annuitizing, right? So if this whole episode so far, you're like, well, this is fine, but I don't give a shit about lifetime income. I have a pension, I have Social Security, I have other investments, 4% rule, which we didn't cover yet. All that shit, right? And you're like, I just have some cash that is getting just, its face ripped off by inflation right now, and I just want to earn some more interest and know what I'm going to get, right? Well, here you go. Fixed annuity might be for you depending on your age, right? This is generally not a good idea for younger people, but for those that are a little bit older, typically mid-50s and beyond, it could be a great solution. So it will have a guaranteed rate for a period of time, depending on the contract. If it's a 3-year contract or a 3-year surrender, normally the rate's going to be guaranteed for 3 years. If it's a 4-year or 5-year, normally the rate will be guaranteed for 4 or 5 years. Is typically how these work. And that's going to be whatever the current rate is. And then the contract will also have, similar to number 3, a guaranteed minimum interest rate. So they might say, here's the rate we're going to pay you for the next 3 years. And then after that, we promise that the rate will never go lower than X, right? That's the minimum, X. And the current rate, the guaranteed rate, the stated rate is going to be whatever they're offering to pay you for that period of time. You can leave the funds afterwards, right? So you can leave them in a contract like that typically. Every contract's a little bit different. Most of them, once you're out of that surrender charge period. So if it's a 3, 4, or 5 year contract and you've been in it for 3, 4, or 5 years respectively, and you decide, hey, I just want to leave my money in there to continue to grow. Normally, not always, some contracts renew with a new surrender schedule, so check your contract. But a lot of times, once you meet the surrender schedule, you can leave the funds in there and the contract remains fully liquid, meaning that you can access your money at any time for any reason, in part or in full, right? However, the interest rate that they pay after the surrender charge period is over is oftentimes lower than whatever the initial rate was. So you want to pay attention to that. It will never be lower than their minimum interest rate, but it's probably going to be lower than what you were getting initially, unless rates have changed significantly over that period of time that the funds were in there. In some cases, it could be the same as the current rate, but most often it's not going to be. So as an example, you might have a 3-year contract that says we're going to pay you 4% interest and the minimum interest rate we'll ever pay you is 1%. And after the 3-year period is over, instead of getting that 4% that you were getting, all of a sudden now you're getting 2.5%. Just hypothetical example, right? That's typically how that would work. It's less than the 4 that you were getting. It's more than the 1% minimum. And they might choose to do that. And then you go back to the drawing board and see what else is out there. Do you want to lock up your money again? Does it make sense to do so? Are you happy with 2.5% or whatever the rate is? And those sorts of things, right? So that's kind of how you'd be thinking about that. The major benefit, as I mentioned, is while in the accumulation mode, essentially, right, the accumulation period, the interest is tax deferred. So quick example, somebody puts in $100,000 into a contract. Over time, it's a fixed annuity. Over time, that account value is now $105,000. They've met their requirements. There's no more surrender charges. They're out of the contract, or not out of the contract, but out of the surrender charge period. And they say, okay, I want to take some money out. So I started with 100, right? That was my basis. That was my premium. That was my contribution. It's worth 105. That's my account value or my contract value. And now I want to make a withdrawal. Let's say I want to take out 15 grand. Most people would say, well, you put in 100, it's worth 105, and you're taking out 15. That's a return of your premium, non-taxable. And the IRS says, ha, 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 fuck you, right? Unfortunately, that's not how it works. So in this particular case, again, as we mentioned earlier on one of the other contracts, it is last in, first out. So the last monies that were credited to the contract or that were put into the contract was the interest. We put in 100. In this example, we earned 5,000 in interest. So that first 5,000 that comes out, that last money in, that 5,000, is the first money to come out. And the IRS says, all right, you deferred the taxes while it was in there, but now we want our tax money. So that $5,000 is taxable. And the next 10,000, remember, we're taking out a total of 15. First 5 is fully taxable at ordinary income. The next 10, in this particular example, would be considered a return of premium or return of principal, and therefore that would not be taxable. So they're very advantageous while the money is in there growing. However, you need to be cognizant of when you start taking withdrawals and distributions of that LIFO, that last in, first out, LIFO, last in, first out method in terms of how the taxes are calculated. Again, not tax advice. We don't give tax, legal, financial, or any other advice on the show. Quick reminder, we're getting pretty long here, so I thought I'd throw it in there again real quick on you. Next, we're going to talk really quick about taxable equivalent yield. So let's say we're going to kind of pick in the middle here. Let's say somebody's in the 24% tax bracket, okay, and federal tax bracket, and they are getting 3% at their local bank or credit union for CD rates, right? Well, for that particular person, 3%, which by the way is fully taxable every year, they're going to get that 1099 INT for interest income, is equivalent to about 2.28% net after taxes, okay? Now, at that same 24% tax bracket, 3% tax deferred, say somebody used a fixed annuity, would be the equivalent of 3.95% taxable. So anytime you're looking at fixed products or fixed interest rates and interest that is earned, it is important to at least be cognizant of and be thinking about the taxes and how that works and the tax implications of the interest that's earned, especially if you are planning on keeping the funds in a contract or in some type of deposit product or vehicle for an extended period of time. If you're going to keep it in there for a while, the longer you can have the assets compounding tax deferred, the better off you're going to be, and the bigger deal the tax drag is going to be on that bank or credit union product. It's not to say never to use that, but it's just saying that especially if you're, again, about age 55, 60 or older, depending on the surrender charge on the contract that you're looking at, you typically would probably be better off using a fixed annuity than you would be with a bank or a CD. And one of the reasons for that, I know I mentioned the age thing a couple times, is that there is a 10% penalty for withdrawals from an annuity contract under age 59 and a half. So that's why if you're a younger person, you probably don't want to be looking at a fixed annuity. That 10% does not apply to the first two things we talked about today on anything that is annuitized. So if you had a SPIA, a single premium immediate annuity, and it was annuitized, which that's basically what you're getting, that stream of payments, it is not subject to the 10% penalty. Similarly, on the DIA, the deferred income annuity, is also, because that's annuitized, is not subject to a 10% penalty if you're taking money out before 59 and a half. So that's important to know. Generally, on these fixed annuities with no income riders, there are no fees. unless you're withdrawing funds early. We talked a few times about the surrender charge period. Normally during that time, the company will allow you to take out a certain percentage, we call it the free out typically, without any sort of penalty whatsoever out of the contract, okay? And some contracts, check your contract depending on your state, may also have, in addition to a surrender charge penalty. So a surrender charge penalty is only going to apply if you take out too much too soon. So if you have a 3-year contract and it basically says you can only take out 10% in years 2 and 3, and you take out more than 10%, that additional, or what we call an excess withdrawal or distribution, would be subject to a surrender charge penalty. If you had a 4 or 5-year contract, same thing. Anything that you take out within that time frame above and beyond the free out, above and beyond what the insurance company allows you to take out without penalty, that additional or excess amount would be subject to a surrender charge. In addition to that surrender charge, depending on your contract, it could also be subject to something called an MVA, a market value adjustment. And that gets a little tricky, but basically when you put money into these contracts, the insurance companies have to do something with the money. There are certain time commitments and time frames that they have to lock up the money depending on how they're investing the funds. And if interest rates move significantly in one direction or the other, and you go to redeem funds early, outside of the parameters that you're allowed to, any sort of market gain or loss that the insurance company experiences by having to redeem their investments early to basically pay you back gets passed on to you, right? So depending on where interest rates are, if interest rates were to go up, then typically you're going to have a negative market value adjustment. If interest rates were to go down, typically you could have a positive market value adjustment. Usually it's the inverse as far as the MVA goes. Mortality credits that we talked about earlier when we talked about annuitization with SPIAs and DIAs, those mortality credits do not factor into the interest rate earned on a fixed annuity like this. So they would only come into play if a client later decided that they wanted to annuitize that fixed annuity. So you could put some money in. I think we've been using the example of 500 grand. So let's say you put 500 grand in, you want to earn some interest, you want to defer taxes on that interest. And then all of a sudden, based on your situation and your plan, something changes and you decide you need or want lifetime income. And you say, well, I wasn't planning on annuitizing, but let me go ahead and get a quote from the company and see what those payments would look like. You could always choose to annuitize that contract later. This is different than what we talked about in number 3, where you could also annuitize, but you had an income rider in the last section on number 3. And you were already taking distributions out of the account back in section 3, and you were depleting the account value in section 3. That's when I said probably doesn't make sense to annuitize at that point once you run the account value down. But in this last section here in section 4, where we took all the income stuff and pretty much just kicked it off to the side and said, hey, we want something that earns more interest, that defers the taxes. What do you got? And we talked about fixed annuities that did not have an income rider on them. Still, though, because it is a fixed annuity, you will have the ability to annuitize that contract. And you were never paying a fee along the way to have the quote unquote privilege of being able to do that. So I know this probably got a little bit confusing towards the end. The point is, there are different use cases for fixed annuities. Let's just do a quick recap of everything we talked about today, just to touch on some highlights. So we had 4 components of the show, right? At the top of the show, we said when we talk about annuities, we can have an immediate annuity or a deferred annuity. Right? So it's either immediate or deferred. And then the next thing is it can be a single premium or a flexible premium. All right. Sections 1 and 2. Section 1 was single premium, so one time. Immediate annuity starts pretty much right away within a year. And that was a form of annuitization, typically for lifetime income, right? Next, in section 2 was very similar, also typically a single premium, but this one was a deferred income annuity. Deferred meaning that payments and income stream starts later. This number 2, this section 2 here, was also part of annuitization. So a SPIA and a DIA, single premium immediate annuity, and a deferred income annuity, single premium deferred income annuity, both fall under annuitization. Irrevocable decision, one-time decision, typically for lifetime payments, right? In section 3, I think is where it got a little bit confusing potentially. And we said, hey, how do we do what we just did in sections 1 and 2, but still have a chance to get out if we want? That was section 3. We had fixed annuities with some sort of lifetime income rider attributed to that contract, And depending on the rider and depending on when you started taking income, it would pretty much tell you, hey, you are able to take out a minimum of this amount or a maximum of this amount. And you could typically do that for life. So you could get the benefits of annuitization, but after a certain period of time, if you changed your mind, you could. Sections 1 and 2, done deal. Section 3, within the parameters of the contract, you can change your mind. Finally, in Section 4, what we just talked about most recently was a fixed annuity, right? And it could be single or flexible premium, but a fixed annuity, deferred fixed annuity, where people would want to use it basically for the ability to earn more interest and defer taxes on that interest. There's no income rider, so we're not paying an additional fee. We're not planning on doing any sort of annuitization when we set it up. However, because it's an annuity, we have the ability to annuitize it later for income if we choose to. But that was not our intention when we established the contract. And if we never want to use that, we never have to use that. If we don't want to do it, we never have to do it. And again, a lot of people, when they use it for the purposes of earning a higher interest rate, deferring the taxes and all of that, they never annuitize and they never intend on annuitizing. So the takeaway is fixed annuities can mean different things in different situations and they can have different use cases. You can use a fixed annuity for retirement income purposes. You can also use a fixed annuity just to simply earn some interest on your cash. I wouldn't suggest doing that, again, if you're on the younger side, because if you're just doing it to earn interest on your cash and you decide to take a withdrawal before 59 and a half, you're going to get killed with a 10% penalty. So you probably don't want to do that. All right, that's pretty much a wrap on our show, episode 17 on fixed annuities. The next show, in episode 18, we are going to cover indexed annuities, one of my favorites. So thank you for your patience and sticking with us to the end. Shout out to everybody. Feel free to share the show. Feel free to listen to it again. Hopefully you took some notes. And until next time, we will see you in the next episode.
Check the mic and make sure it sound right, boys.